If you thought Gabriel India was just a shock absorber company, this Q1FY27 breakdown is going to change how you see this stock completely. We're diving into Gabriel India Limited and unpacking what management is calling the EV stealth play and Project Jupiter catalyst. So stay with me, because by the end of this video, you'll understand exactly why this quarter matters so much.
Let's start with the headline numbers, and they're strong. Revenue came in at 1,274.25 crore rupees, up 18.9% year-on-year. Profit after tax, or PAT, landed at 75.97 crore, growing an impressive 27.4% year-on-year. And earnings per share, EPS, came in at 4 rupees 29 paise, up 27.7% year-on-year. This wasn't a one-segment story either. It was a broad-based performance, powered specifically by outperformance in the two-wheeler, three-wheeler segment, and commercial vehicles. Now, let's zoom in to the standalone operating dashboard for more context. Revenue, again, at 1,274.25 crore, up 18.9%, driven by strong OEM traction in two-wheelers and three-wheelers, which grew 21%. EBITDA came in at 107.20 crore, growing 7.4% year-on-year. But here's the nuance. That revenue growth was partly offset by higher operating expenses. And PAT, at 75.97 crore, up 27.4%, was supported significantly by higher other income of 18.68 crore. This part of the video is important because it tells two different stories depending on which margin you look at. EBITDA margin actually contracted by 90 basis points, down to 8.41%. Why? Cost inflation in raw materials and a sequential rise in employee expenses of 9.9% quarter-on-quarter. But flip to the other side, and PAT margin actually expanded by 40 basis points to 5.96%. That expansion came from strong non-operating other income gains and tightly controlled interest and finance costs. So operationally, there was some pressure, but the bottom line still improved. Now let's talk balance sheet strength, because this is where Gabriel India really stands out. Liquidity sits at 253.6 crore in cash reserves, which are being deployed for operations and capex. Net leverage is just 0.09 times debt to equity, which is an extremely minimal debt profile. Asset productivity is strong too, with return on assets above 11.5% and a fixed asset turnover of 6.8 times. And return on equity has historically stayed robust in the range of roughly 17.8 to 18.4%. This is a company operating with a genuinely fortress-like financial foundation. So where does all this revenue actually come from? Breaking it down by segment, two-wheelers and three-wheelers, including aftermarket, make up 64% of revenue, the single largest chunk. Passenger vehicles contribute 21.5%, commercial vehicles add 12.5%, and trading revenue is a small sliver at around 2%. On the channel side, 88% of business comes through OEMs, with just 12% from the aftermarket. And Gabriel operates through a network of 829 partners and 30,000 retailers. Here's where the moat becomes obvious. In electric two-wheelers, Gabriel commands a 57% market share, essentially unrivaled. In commercial vehicles, that share is even higher at 88%. Zooming out, total two-wheeler market share stands at a commanding 32%. While in passenger vehicles, it holds 23%, including a dominant 66% grip specifically within the utility vehicle subsegment. This is a company with genuine pricing power built on category leadership. Now, is Gabriel just riding the industry wave, or is it actually beating it? Let's compare. In the two-wheeler, three-wheeler sector, industry two-wheeler production grew 22.8%. and three-wheeler production grew 39.1%, while Gabriel's own sales in this segment grew 21%, supported by traction with TVS, Honda Motorcycle and Scooter India, and Yamaha. In commercial vehicles, industry production grew 15.2%,
with light commercial vehicles up 20.8%, while Gabriel posted 13.3% sales growth, driven by cabin dampers and a start of production win with Ashok Leyland. In passenger vehicles, the industry benchmark data is still pending, but Gabriel delivered 5.5% year-on-year sales growth, fueled by a start of production win supplying front strut dampers for the Sierra EV. Now for the big one, Project Jupiter. This is a transformative structural move. Gabriel India is combining with a 28.99% stake in HL Mondo Anand, valued at 2,231 crore, and a 30% minus 1 share stake in HL Klemov, valued at roughly 935 crore. Together, management projects this delivers approximately 13% pro forma EPS accretion, and this stacks directly on top of the roughly 38% EPS accretion already achieved from the earlier Project Rise. That's a meaningful compounding effect on per-share earnings.
So what does this actually mean strategically? Picture 3 concentric rings. At the center, Gabriel's current dominance, ride control and dampers. The next ring out, steering and braking systems, brought in through the HL Mando integration. And the outer ring, ADAS and automotive electronics, brought in through the HL CleanMove integration. Put together, this positions Gabriel as the central listed growth engine for the entire Anand Group, capturing next-generation automotive value well beyond its traditional dampers business. Let's talk price and valuation. At the time of this data, Gabriel's market cap on a pro forma post-Jupiter basis stands at roughly 25,000 crore plus. The transaction reference price per share was 1,305 rupees 89 paise, and the trailing price-to-earnings multiple works out to roughly 89.5 times, based on FY26 standalone EPS of 14 rupees 59 paise. The key insight here: this multiple already prices in aggressive growth expectations, so execution on that 13% Jupiter EPS accretion is critical to justify the premium.
Let's run a quick health check. On the green check side, core operating performance is driving PAT, with no heavy one-off items propping up the number. Leverage remains incredibly low at 0.09 times debt to equity, and CapEx is disciplined at 32.3 crore for the quarter. Now, the caution flags. Net working capital days rose to 33, up from 20, meaning cash is getting tied up for longer. Funding integration will require roughly 1,285 crore in cash for the M&A stakes. And there's cyclical exposure, given the high reliance on two-wheeler and passenger vehicle OEM volumes. So how do we synthesize all of this? The bull case rests on market-leading EV penetration, with 57% share in electric two-wheelers, volume-driven revenue expansion of 18.9%, and a transformational shift into ADAS and electronics through Project Jupiter. The bear case centers on OpEx and input costs pressuring EBITDA margins by 90 basis points, real execution risk in integrating complex, high-value M&A, and a stock that's arguably priced for perfection at current trailing multiples. Both cases are backed by real data, and the truth likely sits somewhere in the execution. So here's the real question. Does Project Jupiter justify this premium valuation, or is that margin compression a red flag you can't ignore? Drop your take in the comments. We want to hear where you land on this one. And if you found this Gabriel India's Q1FY27 earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.